Hey guys, this is Tom Burns from Presario Ventures with my good friend and partner, Darin Davis. Welcome to our one and only webinar. Hopefully, if y'all are like me, you've got webinar overload. So we're going to keep this short, but I tell you, we're pretty social company here, and most of you that are, and we see some people that are on the list. You know, a lot of people are our investors, and they know that we have get-togethers, and we like to connect and do a little bit of teaching and learning and just, you know, a little bit of cocktails, things like that. So we miss that. It's been a long time. So we appreciate everybody that's on the call. And if there's anybody we haven't met, we really look forward to meeting you in person sometime in the future. We're just dying really to get person to person to where we can shake your hands. So anyway, why are we here and why haven't we seen you? Well, it's because of this pandemic. There's a big virus going around. COVID-19's caused problems. And it's a health issue, and I hope that everybody out there is healthy and safe, and we're praying for you if you're having any problems. It has hit my family in probably the worst possible way, and so I can certainly relate to any of your problems that you might be having. But what else has this thing caused? It's caused an economic issue. We've been sheltering in place for 10 weeks now. Yeah. 40 million people are out of work. Some of them are supposed to get their jobs back. We hope they do. We hope all of them do, but you know, will they really? So it's caused some issues. There's been a little bit of consternation about where to go and what to do. And so we thought we'd just kind of sit back and give a little bit of perspective today. That's kind of why we're here, and we'll try to keep it short so you can get to your dinners.
Yeah. And guys, I just want to say hello. And it has been kind of weird being the social group that we are and kind of more family oriented, not seeing you guys like we have been. But we wanted to take a little bit of time and talk to you just kind of really what's going on now with us. Look at what the future looks like, and then take any questions and answers from you, or questions from you, and then we'll try to provide some answers. One thing I want to bring up is the what's happened at our company in the past and why you really haven't heard a lot from us. We have kind of decided to stand down. We thought, and stand down with confidence. We thought, let's step back and let's see really what's going on. And we've learned this from a lot of experience. And Tom, I'm going to let you kind of start off with your experience first, and then I'll trail back into mine. But it wasn't because we didn't want to speak to you guys. It wasn't because of anything other than we really wanted to stay calm and just see what was happening in the market, because with our experience, we thought it gave us a good position to do so.
I tell you, and it's kind of start with attitude. We're calm right now. And the reason we're calm is because we've been through some stuff. I was always told that emotion is inverse to intelligence, and calm's a nice, low, laid back emotion. And so intelligence can be high. As Darin just told me probably 20 minutes ago, he said he's never made a good decision when he was emotionally excited. So we think that calm helps us make good decisions, and we're calm. And why are we calm? Well, we know that life moves in waves, right? Light and sound travel in waves. Stock market goes up and down in waves. There's waves on the ocean. They come. Every time one comes, another one usually follows behind. So does the macroeconomic environment. And so we've been riding up. We've been riding up the wave for the last 10 or 12 years since 2010, 2008. And so it's been a good time. And maybe we're kind of cresting that wave now. We don't know. We don't know the future, but it sort of feels like we've been at the top for a while. So a fellow named Jim Rohn is a personal development speaker and a really well-known fellow in certain circles. And he used to, instead of using the term waves, he would call it the seasons of life and the seasons of business. So it starts with spring when you're excited and you plant your seeds, right? Summer, you grow them. In the fall, you harvest your seeds. So you need to plant your investments early, you harvest them in the fall. Then comes the winter time. It's a time of rest. Some may call it a time of stagnation. There's, the ground's hard, you can't plant those seeds. Winter's not necessarily a bad time. Christmas and Thanksgiving come at winter. So it's not a bad time. And it's also a time that we know is going to come every year. Every year, winter's going to come. So we weren't surprised. We started our company together probably 10 years ago, and then pivoted about 3.5 years ago to Presario Ventures. When we started, we knew that we were probably starting into a headwind. We felt that there was going to be some sort of issue, some sort of recessionary type pressure. It didn't bother us because we're confident in our business plan. We're confident in real estate, and it has served us pretty well. And the reason we were confident is, per my past experience, I've been through a number of these things. I'm getting gray haired enough that, in 1987, I wasn't an investor so much. I was learning how to be a doctor. Some of you may not know, I started life as a physician and still continue to do that. I was in a hospital in October of 1987, and Black Monday came, and the market dropped 22%. And I tell you, all the doctors and people in the hospital were running around like a meteor was heading towards Earth. So it was a big deal. They thought their life was over. Everybody pretty much got through that. Fast forward to 2001, there were issues in the 90s, but 2001 was a pretty big inflection point with the dot-com crash and 9/11. That changed things. Things did change. We did survive through that. I learned some lessons there. I learned some lessons about the stock market. I learned some lessons about real estate. What I learned was that my small real estate portfolio was relatively stable. Moved on through 2008, 2009. People's memories do get a little short. Everybody forgot about crashes, and people were buying things in 2007. Then came that crash. Well, I'd learned a few more lessons that helped me a little bit, but, didn't know everything, learned some more. And it was during that time that we started our biggest projects. So what happened through all those is that we found that they can't eat you. You're always going to survive. Real estate was very stable. My real estate was very stable through the 2008 to 10 crash. I think, as I've probably told you, that the worst my personal real estate did was flat rents. Yeah. That's pretty good. That's a little better than the stocks, I think, who went down 50%. So the past really has molded who we are, and it's really given us our philosophy of consistency and cash flow. So that's what I got out of my past, and that's why I feel pretty calm. What'd you get out of yours?
Yeah, I mean, a little different, but I think we came together at the right time. Yep. One of my regrets is I was more in a panic mode. I mean, I sold assets that I wish I had kept. I remember back, and I know I was in San Francisco working for Yahoo in 2001. I panicked. Okay. Sold all my stocks. Boy, I was one of those guys, buy high, sell low. Just did the same thing in real estate in 2006, 7, 8. Same thing happened. I said, you know what? I'm not going to let this happen again. I've learned in the late 70s. I learned in the late 80s. I learned in the mid 90s. I learned in 2001. I've learned in 2008. I've kept learning something. Here we are today. And I think some of the things that came out of that is we decided to choose a business model that would really help us to endure or weather the next crisis in some form or fashion.
We actively sat down and talked about it.
Yeah. And just a couple of things that we did. We said, you know what? We saw some friends that had some short-term interest rates on their real estate loans. And they were making decisions based off of the maturity of their loan and not the asset itself. Some guys got taken down and lost everything on that. Getting fixed long-term debt was something we said we're going to do. We said we're going to make sure we build up a lot of capital reserves, yep. So that we could weather a 1 or 2 year downturn. So little things like that we implemented back in 2010, 2011, and continue to implement all the way up till today have now served us very well.
It's kind of really defined who we are now.
It is. So, it is. Absolutely does. So,
and so that's the past. You can't. To develop the wisdom to make your decisions in the present, you have to have past experience. And in order to create a better future, you need to have wisdom in the present. And so we hope we're developing some wisdom. We'll probably find out what we missed in this crash as well, as will many of you. You just have to keep learning. You have to keep moving, keep your knees high, keep your head down, keep moving. But that brings us to where we are now. So that's sort of our evolution. We became who we are. And I tell you, we're feeling pretty good. Just to give you a few numbers, portfolio wide for us, we are very close to normal collections. Not completely normal, but probably between 1% and 3% different from year over year collections. So that's a good thing. That's been April and May. We expected May to be a lot rockier. It's done very well. We'll see what happens in June, July. Some of the unemployment benefits run out at those times. We are aware that things can change. Right for now, we're doing well.
Can I add something to that? I think it's just really important. When this whole thing started in mid-March, the pandemic started, the COVID-19, we got calls from our lenders. And it was interesting because at first I was thinking, wow, we can restructure our debt, or wow, we can defer stuff, or wow, we can find some way to make our asset, perform good or even better. As we took all that information in and looked at what we had and looked at our collections and our reserves and we decided not to take anything. We said, we don't need this because we think it may cause more of a problem later on. We said, we have good rent collections, we have good assets, we have good reserves. And we said, you know what? Thank you, but no thank you. We just didn't need it.
I'll tell you, and a good decision, because later some information came out that although forbearance is being offered by the lenders, it still puts you in a different class. It puts a little flag on your file. So we decided to just stay the course. And so, we're currently, we're not sitting on our hands, we're not sitting on our laurels. Things can change next month, but what we're doing, we're using this time to talk to make sure that we're preparing for the future. We're talking to the brokers, we're talking to equity lenders, developers, builders. We are staying in the game. And that's the best way to prepare for the future, is to stay in the game. A friend of mine says the best time to buy an umbrella is before it rains. We're buying that umbrella now, so we've got it when the time comes. So we're pretty excited about the way things are going now. We like the numbers, and we just continue to increase our experience, increase our education, and we're preparing for the future.
Yeah, and we'll talk, and I kind of want to bring up why we call this invest in the now. It
point.
maybe is not so much about investing with, monetarily with money, but what Tom said right there, I think is incredibly important, is that we're investing in our resources. We're getting rid of things that we don't need anymore. We're leveraging this time to find out exactly how can we refine our business model. How can we find the right personnel to help us get to the next level? We've actually taken this 90 days, and I'll tell you this, I worked more in this last 90 days. I was 6 to 6, 12-hour days. When this whole thing started, I said, I'm going to have a lot of free time. I had zero free time.
I'm so sick of my computer.
I had no free time. However, we did learn a lot, and we have a couple of announcements that we'll make a little bit later. Nothing major, but I just want to see the direction that we're going, and we've just kind of sharpened our tools, all of them, every single one of them we have.
And, so that's kind of where we are now. As we talk about the future, we're pretty excited. And Darin's going to tell you about some of the things that we're executing now that is going to make our future nicer, make your future nicer. Look, our whole goal and our whole business plan has always been to provide you cash flow and appreciation, tax benefits. Our whole business plan is to provide service to you. We all win if we do that. But we are excited because, as you look at where we are, in fact, almost before going to the future, I might want to talk about where we sit and where most of our assets are.
Yeah, let's talk about that. And this is by design, guys. So back in 2010, we really took a step back and said, what's important? We need to really focus. And we not only need to focus on the business model, but everything related to the business model. And we knew we'd had enough experience, both being from Texas and living in Texas most of our lives, that the business climate here is incredibly strong. Jobs are starting to pour in after 2009, 2010. The business economy here, we're just fortunate. We're real fortunate that we live here for business and personal. But we started looking at let's build the defensive strategy. Let's see how we can grow into this. And we said, we have what's called the Texas Triangle, the Golden Triangle in Texas. And where that is that's on the north side, Dallas-Fort Worth Metroplex, which is just massive, coming down to the San Antonio, Houston, Austin area. Now, for you guys that are old Texans or Southwest Airlines people, that was Herb Kelleher's original business plan on the back of a cocktail napkin. Yeah, that's where he started.
Not a bad guy to follow.
Yeah, that's where he started Southwest Airlines. Here we are 45, 50 years later, and it is still one of the predominant growth sectors, regions in the nation. Has been and has continued to probably be that way for the next 20 years.
Nice.
Jobs are here. Infrastructure's here. We are right up and down the I-35 corridor. I don't see us really moving outside of that. It's worked for us in the past. It's continuing to work for us. If you look at kind of urban versus suburban, we are going to focus on, we like that secondary suburban market. The peaks and valleys, the highs and lows are far less. It's far more predictable in the suburban markets, more that garden style product. That's where a lot of people are starting to move anyway now. I think the
Nice.
cities are getting a little congested in this, pandemic. I mean, it's a life changer. It's definitely a game changer. The cities may not be quite as popular as they have been in the past.
Yeah, you wonder, are people going to live out a little more spread out? I mean, Austin's traffic's horrible, but 20, 30 minutes you can get to Austin. So, we are excited. I mean, there's opportunities. There's a little bit of chaos going on now, and out of chaos comes opportunity. So we think there's going to be options. And, Darin mentioned, I just have to mention the jobs again. We tell people our business plan is practically, up and down I-35 corridor, and that's Dallas, Denton, Fort Worth, Austin, San Antonio, those areas. We will look at Houston.
We'll include Waco.
We'll include Waco.
Yes, we will.
Just as a place to go buy kolaches. But we love it. And there are jobs coming in. Austin's got $1 billion Apple campus coming. There's 2 new hospitals that are going to be built kind of in that same area. People are always coming here outside where one of our properties is. There's people putting headquarters along the tollway that somebody built east side of Austin. Dallas, Fort Worth, Plano, Frisco area is just sucking in headquarters from all over the world. So,
in the corridor between Austin and San Antonio, New Braunfels,
yeah.
Seguin, San Marcos, all at Kyle. I
New
mean,
Braunfels,
all of it.
Yeah, one of the fastest growing cities of its kind. So,
Mhm.
it's always been the business plan. Multifamily does well. Our business follows jobs, and just heard today that Austin's #1 as far as ingress and egress, as far as people moving in and moving out. So when people are moving in, they're typically coming here for jobs and they need a place to stay. We know we're still underbuilt on apartments. You just have to pick the right place. So you probably won't see us on the inner cities. You never would have seen us, and fighting with the urban big fellas. But we sure do like the secondary markets, and I think we've got some good plans going forward. We've got some people to introduce you to. We've got actually some products or some options that maybe you haven't seen from Presario before.
Yeah, so let's talk about the future here.
Sure.
It's probably no big secret that there's probably a high probability that we'll be refinancing some of our assets. I think that we'll be able to significantly reduce by a percentage basis the debt that we have on these assets, which will give them a healthier performance, which at the event becomes more cash flow to our investors. We've also been getting a lot of questions about diversification within Presario over the last couple of years. Hey, do you guys have anything shorter term? Do you have anything a little different than your common equity that's got a 5 to 10 year horizon on it? Well, a couple of years ago, we started looking at a concept of using pref equity. And by that pref equity, it's by design, a shorter time frame for the investment, more predictable. The biggest difference on it is that you don't get this big bump on the back end, but you get an early exit with a pretty much a assured, almost known guaranteed return based off of the structure of the deal. So you might see that from us. We like the positioning of that asset. Some people want longer term. Some people want more surety and short term. Some people want a bigger upside. It fits really nice into what we call our capital stack with debt, equity, common equity, and preferred equity. So you'll probably see that from us as well.
And we're not flippers. So we'll sell stuff if it makes sense, but by and large, we're holders, and we like to, as Darin always says, flip the debt instead of flip the property, so we prefer that. So we are, and we needed to have something that was maybe a little more shorter term, a little more predictable return, or with a predictable return. So it's a nice diversification. Yeah.
And you'll still see us doing development and acquisition. We like the yields that development provides. Acquisition's gotten a little tougher. What's called cap rates. There's not been a lot of sellers willing to come off their prices. We don't know if that's going to happen or not. We think Texas is going to be a little more difficult, especially in the Austin metro area. Yeah. So you might see us really sticking with more development than acquisition. But if we find an acquisition target and we can get it at the right numbers, we will do it.
So that's most of what we wanted to say, except we got some introductions to make.
Yeah, before we get into our question and answer, and again, I just want to tell you this may tell you a lot about us right now. We have hired 2 new people. We are so excited about the future and the growth. We knew our business model was going to continue to grow. We have 2 new people that have joined us, but before I introduce them, let me get a couple things out there that I want to talk to you guys about. Most of you know Allison Silver. Allison is on maternity leave. She has a healthy baby girl who is a month old today, which is pretty cool. We're all very excited for she and her husband. We have also put Robin and promoted Robin into the Director of Client Relations. So you guys that talk to Robin Massey on a frequent basis, we have put her more in touch, or putting her in a position to be more in touch with you guys. She does a fantastic job, and we know that as we continue to grow, we need to be keep our communications more frequent. Robin does a fantastic job with that. Megan McLand, who joined us in February, has 5 years of commercial real estate experience. And I will tell you this, that she hit the ground running, no learning curve at all. Day one, she was already running the office, and it was just a breath of fresh air bringing her in and having her step in. And then Prima Chow. Prima has 7 years of commercial real estate experience, primarily in the multifamily. Prima is going to be working pretty closely with Allison on asset management, acquisition, and on our equity capital raises. So 2 new people. We have a family of 1, 2, 3, 4, 7 now. Yeah. So there's 7 of us that are in the office. We're expecting big, bright things in the future. So, we're going to turn it over to the Q&A now and see if we have some. I know we have some earlier questions that we got. People were going to.
I just wanted to summarize. We really just we'd really like to shake y'all's hands. That's what we'd like to do. But we just wanted to kind of give you a little confidence that the sky's not falling. And most of you, I think, have been in this for a while and probably are there anyway. And make sure that just, make your decisions in a state of calm. And then sort of our mantra is pivot, don't panic, no need to panic. Just make sure you pivot to a different business model if need be. And just sometimes you have to have your goals in concrete and your plans in sand, so things sometimes move. So we just wanted to get a chance to talk to y'all and hopefully get a chance to see that we're still alive and kicking. And we will get to the questions if we don't have anything else.
No, I think we had a couple come in that people weren't going to be on the call, but wanted it recorded. Tom, do you want to grab the first one? Yeah.
How do I take advantage of the distress in the market now? Always you do want to take advantage when there's distress. I don't think that it's here yet, to be honest with you. I believe that it's been 10 weeks or so, maybe 3 months. And with the implementation of the CARES Act, there's been a lot of money lent to people, small businesses and apartments. There were loans. The lenders are offering forbearance. So that's going to be a process. And so right now you're not seeing things going, I'm not seeing REO products and people going under. There are signs, there's signals. Single family homes our delinquencies are increasing, 60-day delinquencies are increasing. We're not in that market, but that's happening. That may give us more renters. You never know. I did hear the other day that the forbearance requests and applications have doubled in a period of 2 weeks. And that process takes people through forbearance. And as we said, that does sort of put a bit of a flag on your loan. It's very difficult to get out of it. There's strict rules. So things will take some time to go through the system. We believe that most of the opportunities are going to start showing up in more quantity, maybe Q4, Q1. We're not sure. We don't have a crystal ball. Mine was broken this morning. But we're doing the best we can. So what I would suggest is, as we always talk about, get educated, learn about your market, learn about what you want to invest in, start meeting people, make sure you know who to invest with or where to put your money or where you're going to invest and do your projects, and save that cash. Save as, get your cash, get yourself a war chest of cash. That's my best advice is have some cash and make sure you know what you're doing.
Good. Let me take that next one. We kind of touched on it a little bit earlier about common equity and preferred equity. So let me elaborate slightly on this. And it looks like it's talking about which one should I look to right now? You know, it really is up to you. Common equity, and the way this works, that you have the debt, which is the loan from the lender, and then you have the next is preferred equity, which kind of acts like a second lien, but it's not lien. It's not a lien. And then you have the common equity. Well, as I said earlier, the preferred equity is 2 to 3, maybe 4 years. That would be fairly long. It's an interest rate that's predetermined, and there is a payout schedule, and then you're in and you're out. The common equity guys, they typically have a preferred return, but it could accrue over a period of time. And then they're in the project for a period of time, whether that's, you know, 3 years, 5 years, 7 years, 10 years, and they follow the direction of the market and the GP. So one of them short-term, more predictable. The other one's a little bit longer term, could be less predictable, but it could be a very large difference in the overall return that you get.
Nice, nice. We've got a few more that are coming in now, and I'm going to have to duck my head to read this. So give me a moment.
I'll take that one from my friend in California right there.
Okay.
Okay.
Go for it.
Then you take the one above that. So my friend in California, here's the question. When do you expect the cash flow payouts to resume? Fantastic question. So let me give you why we did it, which you probably most know, and then what we expect going forward. We didn't know what was going to happen in March, April, May. And what I can kind of tell you right now is that, and Tom talked about the CARES Act a little bit, and you know, money's being pumped out by the government, and we think that's probably propping up some of the rent, I mean, the lack of rent collections on that. Yeah. So we really don't know. I suspect we're going to go one more quarter, which will be Q3. We're going to see how rents happen June, July, August. And then if we stabilize at that point and we feel we have enough reserves, I fully expect us to, by the end of Q3, beginning of Q4, we would start picking back up the distributions of cash flow.
We want to see those employment benefits run out. That's end of July. Yeah. We want to see everybody getting and kind of let things settle out. And it kind of segues into the next question. You know, do you think, you know, excuse me for reading it this way. Do you think that, you know, recession tolerance of Class A buildings will, in essence, buffer tenants moving between other classes of property? And do you think that lockdowns will have a medium or long-term effect of encouraging people to stay at Class A or step up from B to A? And are we seeing any changes in mobility between classes? Sort of answer the second part first, sort of the opposite. We're not seeing anything. Everybody's staying in place because right now with the eviction restrictions and everybody getting their stimulus checks, people are they are staying in place. Very low turnover rate. If you look nationally, turnover rate's way down. So we don't have that answer yet. Prediction wise, we do think that maybe the luxury Class A might have some headwinds. I think the Class Bs, particularly the nicer Class B, they're doing quite well, doing very well. The collections on the Class Bs have been great. So I don't necessarily see them moving from Bs to As. And to be transparent, if things got worse and the economy really did tighten things up, I'd probably see them maybe moving from A's to B's, you know, and of course we're in A's, but that's an honest answer. So haven't seen that mobility yet.
Okay. Let me take that next one, or Tom, you can add on once I start here. Okay. It talks about the difference in the return between a value add versus ground up construction, risk adjusted, with a question mark. I got to start off by saying which one's riskier. Okay. That's the, and I will tell you this, our background is not in the value add. Our background is in more Class A acquisition or ground up construction. So what I'm hearing, and this is going to be kind of a non-answer answer, what I am hearing from lenders going forward, that there's going to be more difficulty in getting the value add major rehabs that are not in predominantly solid markets, getting the correct debt for that, which affects your equity, which affects the returns. What we're not seeing is that model is not changing on the side of construction. Now, with that said, we have been using in the past, and we'll probably continue to for the most part, we're using a HUD insured loan which HUD has some pretty good terms as far as leverage. So we're still seeing an 80-20 model, 80 debt, 20 equity. And when you look at the numbers that type of loan product, looking at all the assurances that come in that HUD insured loan, the terms of that loan, it's a low risk, higher yield deal than a ground up for us. But I'm not saying that that's not for value add. You may have something else you may want to add to that.
Yeah, I can answer. I tend to think that risk follows more the talent, education, and experience of the investor, not necessarily the asset sometimes. And so, as Darin said, while we've done a value add or two, that's not our main lane. Mostly the business plan for the value adds has been to buy it at a good price, increase the NOI, and sell it at a higher price. Now, if you could change that model to maybe increasing the NOI and refinancing at a higher price, I'd like to compare those two because we are, as a side note, we're a bit tax averse, so we prefer to pay as few taxes as possible. That's why we like the refinance model. But we do find it difficult to find acquisitions now. The money, I think it's 6 months to a year, or 12 months of escrows that have to be added to the purchase of a value add deal. So, but that's not to say one's riskier than the other. We feel it's with ours, there's construction risk, lease up risk, and that sometimes scares people that haven't been through there. But having been through it enough, we can usually predict what's going to happen outside of force majeure, things happening. So, and that's going to catch both of them. So, it was kind of a non-answer, but we like it. Yeah. Well, that's because we're not BC value add experts. And that's been a fabulous business plan for the last 10 years. It's made a lot of people a lot of money. And I still think there are value adds out there that can be done. And would we do it? If we found a nice product that fit a light value add, we would do it. It's all has to do with the numbers and, the location and the market. So we kind of like doing our HUD deals because we like having, Big Brother looking over our shoulder doing a second feasibility study that matches, that in addition to ours. So we like to create. We know we can create value. Used to be we were looking at 200 to 250 basis point spreads from yield to cost to cap rate, but now it's lower. But we can create our own value, and so we see that as, for us, that's less risky.
Yeah, I mean, and we addressed those two things. We wanted to address construction risk. That's why we went HUD. Yeah. And we wanted to address the rents and stabilization in market. And that's why Texas.
Yeah.
I mean, those were by design. So
yeah, that's our risk hedge. Yeah. So good question. Great question.
Yeah. All these are good questions. So I think, is there one more that just popped in? Here we go.
Okay. You have the answer to this.
Well, one. The next question came in. Any sense as to inflation, deflation effects on construction costs going forward? So as I mentioned earlier, we are probably still going to look at development as being in our core lane here. We are talking with developers and general contractors trying to get a sense of what they're seeing so far. Now, all of our current, we have three projects under construction right now. None of those are being impacted today. We are taking
cost-wise. There are some delays.
Yeah. I'm sorry. Just on construction costs. Those have not been impacted because those are fixed bid contracts. Everything's been bought. Everything's been paid for. Everything's been agreed to. Going forward, we have two different groups we're working with today that are putting bids out to the contractors, and they are getting feedback of 6% and 7%. One group said on some of their materials, and they were getting 10% cost reductions from where we were just a year ago. Pretty significant in a 90 to 120 day swing.
Yeah.
I mean, when you're talking 30, 35, $40 million construction cost and you're seeing 3, 4, 5% cost savings across the board, that's significant.
And that surprises me because the supply chain is limited. A lot of stuff comes from China. And so it actually surprised me.
That's the unknown too. I mean, what's that distribution channel going to look like from China in 6 months, 12 months from now?
Yeah.
Nobody knows. Or at least at this level, we don't know.
So I wish we knew the distant future, but we can just tell you what we know now. So good question. Good
Yeah.
question. We'd love to see it keep going down.
Yeah.
So,
Um,
well,
let's see if we have one more. Yeah, let's do one more here. Are you finding any difficulty with getting supplies because the China trade? Well, we just kind of talked about that, the China trade and tariff issues. Slightly. On the 3 projects that we have, we've had some delays at more on the shipping side. Materials coming in, of course, from China. Nothing that's too significant. We had a delay, for example, one of our projects for the fencing around the pool. It was a month. It wasn't anything significant, but not yet. It's been minor to date, and we truly don't know what that's going to look like at a year from now. There's just too many unknowns on that, which could be, let me say unknowns between Tom and I right now. We're not boots on the ground with the general contractors talking to the major suppliers, but we haven't seen anything from our position as of yet that would really concern us.
yes. And the next question, we don't have suppliers because we don't do the bids for these guys, but some of the contractors, they have been sourcing alternate sources.
Yes.
They've been getting their stuff elsewhere. I mean, that caused a delay, but at least they got it.
Yeah.
So great question. Yeah, it's coming from elsewhere.
Yeah, it is.
So, but it's,
And you know what, that may be something we need to talk about next time. When we is bringing in 1 or 2 of our general contractors.
Yeah.
Because that could be a very big part of things a year or 2 from now. I think
Just
it's
one
good.
more webinar for
Yeah,
you guys.
just one more webinar.
So,
Okay. All right.
but so that was it. We kind of like what's going on right now. We like slow and steady. We like excitement too. We think that's going to come, but we're pretty happy with what's going on right now. And hopefully we answered everybody's questions. Looks like it's kind of slowed down a little bit there. So unless there's any burning questions, we may cut it off here. And
No, I'm kidding. Hey guys, I want to say thank you very much. There's a lot of people on this webinar that I've been with, 20 years. Thank you for your trust. I am very grateful. Been partners with Tom for 20 years. Thank you for your trust. Very grateful. The new team members, thank you. We just are very appreciative and for everything that you do. And our phones are always open. Please give us a call after this call. Anytime, we're here.
yeah, we appreciate you guys. Thanks a ton. All right.
Okay.
Weekend update out.